I would like to highlight 3 key messages on this slide. First of all, JPR has set target for rent growth. Taking advantage of the favorable office market and our own edges, JPR negotiates hard on rent increase. As we pursue the rent growth target of 1.3% per annum, strong internal growth that outpaces interest rate hike is going to be achieved. Secondly, JPR engages in asset replacements. Based on our growth strategy, JPR reshuffles its assets in an active fashion. Since after the last earnings call, we disposed of 3 assets and acquired 2 assets in order to drive yield and quality of the portfolio. Together, capital gains that amounted to 4.2 billion yen have been booked. Third point is on JPR's capital allocation policy. Capital generated from asset sales will be allocated in an optimal manner to drive unit holder values. While proceeds are allocated to unit holder returns and asset acquisitions, they will also be utilized to buy back investment units, given the sluggish price performance since last year. As a result of these measures, adjusted EPU in the December 2025 financial period is expected to surpass 7,600 yen, which was our immediate target. We have also raised the growth target trajectory of DPU by 100 yen. Let me provide details on the recent asset replacements. JPR has sold a total of 3 assets to third parties and booked capital gains as a result. JPR Sendagaya Building and JPR Nagoya Fushimi Building carried unrealized losses and rendered relatively low yields, while JPR Ueno East Building was challenged by its location and age to sustain profitability in the future. On the other hand, Nakano Central Park East and the Royal Park Canvas Nagoya are the newly acquired properties. As these 2 assets bear upside opportunities on the back of recovery in the market, we expect they will serve the portfolio to drive yield in a medium to long run. Turning to discuss the decision on the buyback that we made earlier. Due to change in the BOJ's monetary policies and other factors, the entire JREIT sector market has been under pressure. JPR was no exception, where our price to NAV has been under 0.9 times since last year. Knowing that the office leasing market is on a clear path for recovery, JPR has resolved to tackle with a prolonged doldrums by repurchasing its investment units. After buying back a maximum of 4 billion yen of units, we expect approximately 100 yen positive impact on DPU. In the future, we are going to consider buyback again when price to NAV hovers below 0.9 times for an extended period of time. Effective 1st of July, the investment units of JPR will be split by 4 in expectation of a broader investor base, especially retail investors, and better liquidity. Next topic is on the change made in the DPU growth target. Even though I presented 2% DPU growth target during the last earnings call, asset replacement and other drivers have led DPU to trend largely above the initial growth trajectory. Reflecting the expected impact of the buyback that was announced yesterday, the DPU growth target trajectory is now raised by 100 yen. Going forward, we'll revise our growth target whenever needed, in line with progress in our initiatives. Let me present this waterfall chart to explain factors on resulted DPU on the December 2024 financial period and guidance for the following 2 periods. Adjusted EPU resulted in 7,480 yen for the December 2024 financial period impacted by rent decrease due to tenant departures from MS Shibaura building. Record high DPU of 7,935 yen was marked, driven by return of gains from asset sales. Adjusted EPU is guided to be 7,560 yen for the June 2025 financial period as a result of fully leased MS Shibaura, upward rent revisions in progress, asset reshuffles, and investment unit buyback. DPU is forecast to be 8,030 yen, contributed by gains from sales of Ueno East building. Accelerated positive rent revisions and full-term contribution by Nakano additional acquisition will drive adjusted EPU. It is forecast to be 7,610 yen, surpassing the immediate target of 7,600 yen. DPU is forecast to be 8,100 yen with the use of retained earnings. This slide updates on JPR's occupancy trend. Occupancy rates deteriorated in the December 2024 financial period after tenant departures at MS Shibaura building. Since this property has already been leased up, the occupancy rate based on concluded contracts is forecast to rise to 98.8% in the June 2025 financial period. Occupancy rate is likely to remain high for the foreseeable future, given that we have not received any notice of major lease cancellations. As you can find in the graph on upper left, trend for positive rent revision has gained speed, driven by the rapid recovery in the market. Increase in monthly rent for the June 2025 financial period is 8.2 million yen as of today. Rent upon tenant turnover, as illustrated in the upper right, also turned net positive in the December 2024 period, excluding the impact of MS Shibaura building. Let's switch gears to discuss JPR's external growth strategy. JPR leverages its sponsor pipeline to make property acquisitions. Assets under management have grown at an accelerated pace since 2020, underpinned by its sponsor Tokyo Tatemono's medium-term business plan. Tokyo Tatemono announced its new medium-term business plan the other day, of which core strategy is to accelerate property sales for investors. Therefore, it is our recognition that the sponsor will divest not only properties for sale, but also its fixed assets strategically. JPR will continue to capitalize on its sponsor pipeline to drive growth. Next topic is on JPR's financial strategy. Total of 20 billion yen was financed in the December 2024 financial period, with average duration of 8 years. Long-dated floating interest rate was partially utilized. While debt financing is leveraged on asset replacements, LTV is expected to be 43.7%, which is still relatively low. When it comes to interest rate, another rate hike in July is factored into our guidance. Even though long-term interest rate is on the rise today, we expect it to hover around 1.3% for the rest of this year. While there is unclarity over rate trends, our view is that impact on JPR is limited in the short run due to the diversified maturity schedule. JPR's sustainability initiatives are implemented in all directions, with high credit granted from external bodies such as GRESB and CDP. Our new endeavors include certification and registration on the Eco Action 21 and power procurement by way of off-site corporate PPA. This concludes my presentation. Thank you for your interest and kind support.